not sure who knows Mitch Corman, but he should be joining us as well. And he's probably just having some trouble getting in. He's a lawyer. I'm an accountant by trade. So I'm a partner at MMT in Toronto, you know, and focus a lot on, you know, working with different professionals and, you know, do a bunch of real estate stuff. So really, I think the purpose of this webinar, or whatever you call it, Zoom, is to educate you guys on the latest of, you know, the latest development of these precs. And I'll try to keep the presentation slide short. And if you could, you know, any questions are welcome. Feel free to stop me along the way, or just save them for the end. And really, that's where you're going to get the value, is just, you know, ask questions. There's no such thing as a bad question. And hopefully I can demystify some of the stuff. So why don't I just get started? So personal real estate corporations, I think effective around October 1st, they were allowed, and it was through Bill 145. It's a long time coming. I mean, if you look at the professions, so accountants, lawyers, doctors, dentists, we've been able to incorporate for years, probably since around 2003 or 2006. I forget the exact year. And for some reason, you know, your profession had a longer fight, but it's nice to see that you can now incorporate, because you know, we'll go over the tax advantages. For some of you, it will make no sense, and for others, it will make a lot of sense. And for those of you that makes sense, there's, you know, there's tremendous tax advantages to using these corporations. So when we refer to PREC or PREC, as you might have heard it, it's the professional real estate corporations. So we're going to cover what they are, when you would use them, how they work, the limitations, and how do you start one. So what is it? So it's actually a separate legal entity, meaning you are bound by the Ontario Business Corporations Act. You are considered a separate taxpayer than yourself. So for all intents and purposes, the law views this as a separate entity than yourself. In other provinces, it's already been allowed, and it's been allowed for years. And the clients will engage, while there are marketing restrictions and advertising restrictions and restrictions on when you use the name of your PREC or whatnot, for tax purposes and legal purposes, they are engaging with the actual entity that is the PREC versus you. So it's actually a separate legal entity, and you're bound by the income tax rules that pertain to corporate taxation versus personal taxation. So, you know, in a nutshell, what it is tax deferral. So if you live in Ontario, like you all do, the highest marginal rate, once you get above $220,000 of income, is 53.5%. So you're not even keeping half your money. You know, that's a deceiving number thrown around. The rates start to get really bad at around 150 when you start to approach the 50% mark. Okay, and it didn't always used to be that bad, but it is now. So, you know, many of you, when you have really good years, you know, as you approach, and that's, so when I talk about income, that's your commissions less your expenses. Okay, that's an important differentiator there. It's income less expenses. So, you know, once you get above 150, you're at the 50% mark. Above 220, you're at the 53.5% mark. Well, what if you're making more money than you need, and you can tax yourself at this 12.2% rate? Okay, that's tax deferral. Meaning if you're making more money than you need, you can potentially pay 12.2% versus what could be 50%. So it's almost, you know, a 38% or 40% deferral. And that's why you see so many other professions using these professional corporations. People are making more money than they spend. And I'll get into an example. And they don't want to have that money. They don't need taxed at 50%. They want to have it taxed at 12%. That's deferral in a nutshell. When you eventually take it out, you will be taxed at your personal marginal rates, but hopefully you take it out in a year where you either have less income, or you take it out in retirement when you're not earning as much and you can kind of pay yourself a pension. That's when you turn what would be temporary tax deferral into permanent, more permanent tax savings. So to give you an example, let's say you
just
had,
so you know, I'm with you.
Oh, you came, Mitch. Good, welcome.
I had bandwidth problems. I've got 2 kids at school, both of them learning from home, both of them online, and I had a little difficulty logging in. They're using up all my bandwidth.
Thanks for.
Did anybody introduce you?
Allison did.
Okay, good.
And why don't you introduce yourself?
No, they all know who I am.
Okay, perfect.
Normally not on tax calls. I'm usually on real estate closing calls, but
Right.
but it's all good. And just for you guys know, Jordan's been my own personal accountant for years and years, and was bugging me to set up my own prec because lawyers were allowed to do it years ago, and it took many years before I actually pulled the trigger and did it. And I just think about how much money I could have saved had I done it 5 years earlier, because I just took a long time for me to decide to make that jump. And since then, I've been in control of my own life and not waiting for the September bill, the September 15th tax installment bill, and the December 15th tax installment bill to come. As you guys know, it comes every year, and you're in shock because you're paying based on last year's taxes and not based on what you want to choose to pay, which is what you're going to be able to do in your prec. So that's my intro of you, Jordan, and let's keep going.
Thanks, Mitch. So, yeah, like, a good example of a lawyer being able to do this years ago, and unfortunately you guys didn't have the option, but now you do. So let's look at this example I have on the screen. So somebody earning $250 of income, that means, more than that in commissions, less the expenses, $250 falls out. So let's say you're just a sole proprietor and you don't incorporate, you're $250, you'll pay $102,000 of personal tax, and you have $148,000 left to spend. Okay. Now let's say you make $250 after expenses, but you only need $150, right? In that case, there's $100 left in the corp. You pay 12% tax, basically. You're left with $87,000 in the corp. On the $150 you drew as a salary, you paid personal tax about $50, you left $98. Essentially, this funds retained in the corp only got taxed at 12%. So you're left over, if you add up your personal and corporate money, with about $37,000 more than what you would have if you did not incorporate. And again, it's all because the $100,000 you left behind got taxed at 12% versus 50. And that's your tax deferral, okay? And you can see for anybody making enough money or saving enough because they don't need it for spending money, you can see the rate of deferral these days with the corporate taxes being this low, because corporate taxes never used to be this low and personal taxes never used to be this high. But the rate of deferral is just so high these days, these things become very appealing, okay? So, what are the advantages? We went over deferral, but like in a business like yours where you could have 1 year where you have a fantastic year and you get creams of taxes, and next year you have a worse year and you almost pay no tax. What if you can smooth out your income? So one of the best things about a prec for a realtor is in the years that you have high income or high commission levels, you can get hit in the prec basically at the 12% rate versus the 50, and then take that money that you save behind in a year when you have lower income. So that ability to smooth your income and predict your taxes, and if you do get hammered on taxes in a prec, you're getting hammered at a 12% rate. It's not that painful versus 50. So the ability to, and any commission job, the ability to smooth your income is key. And again, in your jobs, it's a lot harder than mine or doctors, for example, to predict your income. So it's a big advantage to be able to basically predict your tax bill versus someone that can predict their income and knows exactly what they're getting into year to year. You guys don't. So smoothing your income is a huge advantage of a prec, especially in a commission-based business. Then there's, for certain of you that have teams or have, basically you're building something more than yourself, something, and you're bringing up that next generation of team members below you. You can actually potentially sell your prec in a tax advantageous way. I mean, this will not be for everybody on this Zoom, but for certain people that are going to have teams, you potentially could sell your business and pay no tax on that sale, but you need a corporation, and that's where precs come in. So I don't know if Mitch, you want to speak to that one at all quickly?
Well, that's actually been really useful for me in my law practice. So I set up my prec, I don't know how many years ago it was, let's say it was 5, 6, 7 years ago. And now, as you know, I work really closely with Kate Grossi and Adam Richardson and Mike Clark, all amazing lawyers. I want them to become partners in Corman & Company Professional Corporation. And they actually are now, but they've been partners, you know, it started off being income partners, and now I want them to be full partners. I actually want them to own my law firm. So what am I going to do? I'm going to sell them shares in my law firm, and the first $883,000 of it is going to be tax-free to me. So because I'm going to use up my lifetime capital gains exemption by selling them shares and bringing them into full partnership in my law practice. And how good is that to have $883,000 of tax-free money in my pocket?
Right.
That's what you guys, you know, if you're planning on building a team or building your business, I can see some of you on there are starting down that path. That is a great thing to have at your disposal. And if it doesn't work out, there's no harm. You know, you just don't get that lifetime capital gains exemption. But I would hate to be on this call 5 years from now, and some of you have been, you know, killing it in real estate and building a big team, and you never started your prec. And so, you know, you're not going to be able to take advantage of what we're suggesting now with this lifetime capital gains exemption.
Yeah, so that's a good practical on the ground example, Mitch. The other thing is, you know, another advantage is if you're over the age of 65 or you're approaching 65, so you're in your 60s now, you can do certain income splitting that the rest of the people under that age can't do, which is a huge advantage, even if you didn't need to defer. You know, so if you're over or approaching 65, a prec might have a different use than the rest of the people on this Zoom. So how they work, basically you get paid your commissions into the prec, you pay your expenses out of the prec, and just to dispel a rumor, there's no difference on the type of expense deductions with the prec and without the prec. So, you know, you'll run all your expenses out of your prec, and the prec will have a bank account and probably its own credit card. The prec will administer HST. So your personal tax return actually will become relatively simple. You're picking up the salary or dividend that you do, that you give yourself, because you still need money to live off of, right? So you'll pick up that on your personal return, but basically all your activity when it comes to you being a realtor will go through your prec. And I'm not going to get into the difference between salary and dividend right now. We can later if we have time, but you know, you'll have discretion on how you pay yourself, when you pay yourself, and that flexibility, you know, has certain advantages or disadvantages, which your accountant will go over at the time. And maybe I just want to speak to some of the limitation and costs, because that has to be, you know, factored when you decide if it makes sense to set it up or not. So, you know, I mentioned the income splitting rules. It's not so easy just to use these precs to income split like it used to be. So that's a 2018 rule. Mitch, maybe you could speak to legal liability and the prec.
Okay, because there's a lot of people understand that when you have, let's say, a regular holding company that holds assets or is a business, you try to set up that holding company for the purposes of limiting your legal liability. So if the company is ABC Corp and ABC Corp gets sued, it's not you getting sued. With precs, it's a little bit different because we haven't, you know, lawyers, doctors, accountants, and realtors have not been able to shelter their own liability through using a prec. So it's not a holding company in that sense. So you still have your professional liability insurance, the same way lawyers do, the same way accountants do. So what happened with lawyers is when I set up my prec, basically, that was covered under my professional liability insurance, because now it's not just Mitchell Corman, Barrister and Solicitor, it's Corman and Company Professional Corporation. So now I'm covered and my company's covered by my professional liability insurance. In your case, it's a little different, because in your case, your prec is not an active business. It's only receiving the income from your transactions from your trades. So your professional liability insurance is still just covering you. We don't know if you still have to submit the name to your professional body and submit it to your brokerage and submit it to your insurer. And chances are your insurer will just add it as a named insured on your own professional liability policy. But there's no added protection by having a prec. It doesn't limit your liability in any way, shape, or form, as would a separate holding company. That's about it.
So yeah, so you know, to summarize that, is you're not setting these up for liability reasons. Again, you're back to the tax reasons for setting it up. Okay. And costs, Mitch, maybe you can speak to the setup costs from your side of things, or using a lawyer.
Yeah, on our side of things, setup costs are initial cost, let's say $1,500 to set up the corporation, to incorporate it, to file, do your filings, to your articles, resolutions, bylaws, the entire works. You're talking about $1,500, and then ongoing beyond year one, it might be $200 a year to do an annual minutes for that corporation, but that's about it. So our initial setup costs are a little bit on the, well, they're not high, but they're like $1,500, and then ongoing, it's next to nothing. Your
Right.
costs on the accounting side are quite different.
Right. So yeah, for the legal side to get it set up, it's a rather minimal cost and it's a one-time cost. One of the big considerations with a PREC is that there's ongoing tax filing costs, and it's far more complicated to do a corporation's tax return than it is a sole proprietor's tax return, because you have to keep a balance sheet. Basically, the CRA wants to know where all the money's going. That's because, again, they know there's deferrals. So you have to do regular bookkeeping. You're going to need a corporate tax filing. You're going to need financial statements. You're going to need T4, T5 slip if you pay yourself salary or dividend, and support for making the right remittances and tax planning. So typically speaking, with a firm like ours, you're looking at $3,000 to $5,000 for everything. You'll probably hear on the street that there's anything from $2,000 or $1,500 to $2,000 up to $6,000 or $7,000 with various firms. So we'll fluctuate, and the whole thing is that you just need someone reliable, and you have to factor in the costs. So basically, if you're setting up a PREC to save $5,000, you're not getting anywhere, because it might cost you $5,000 to administer it. So you need to have enough savings to make it worthwhile. Another consideration is there's often additional bank fees. I have been in contact with a few of the banks that said they're rolling out programs for PRECs. They basically, the doctors, dentists, the lawyers, accountants all sometimes have programs that they could roll under for preferential fees. I have heard some banks looking at it. I mean, I haven't heard anything concrete yet. I don't know, Mitch, if you have, but I know that BMO is looking at it. I know RBC has a group. So hopefully something comes out with the banking side soon. But as far as I know, in regular practice of corporations, banking is more expensive than personal. It shouldn't be material, but it's something to be aware of. And then also your time. So, these things do, because it's a more complicated structure, there's two things. One, it takes more of your time, and two, they're permanent in nature. You can't just set it up and then take it down tomorrow. You got to wind it down. So, so just some things to consider before setting up the PREC is just the ongoing costs and maintenance requirements.
And in broad strokes, I mean, if you can put aside $50,000 or more each year, you should certainly, in my mind, it's a no-brainer. You should have a PREC. If it's less than 50,000, if it's somewhere between 20,000 and 50,000, and you want to look at each year over year, then you have to take a much closer look at whether it's right for you at this moment in time.
Yeah, that's a good point. And another thing to factor is, which you'll never really see presented, but in practical experience, how do you say this? A lot of realtors have very aggressive expenses, meaning they put through everything, right? And if you're not incorporated and the CRA adjusts you because they don't like certain of your expenses, you have a 53% impact on your adjustment if you're in the highest tax bracket. So let's say you have $1,000 of, advertising costs. They think it's personal, you think it's business, or you can't find the receipt. If they adjust you, you pay $530 of tax plus interest and penalties. If they do that same audit in a corp, on that $1,000, you pay $120 and then interest and penalties. So for those of you that are very aggressive with your expenses, having a PREC in the middle might actually help you if you ever get audited. And pre-COVID, the CRA was extremely aggressive on audits, coming around a lot. And, with the government debt right now, we're expecting they'll be back. So I never really advocate for the general person to incorporate a PREC to break even. But if you're extremely aggressive, you should have that discussion with your accountant, because it might save you some pain if you are worried about an audit, basically. Okay. And you won't ever see that written down anywhere, but that's the reality of it.
That's why they're recording us.
Well, it self-destructs in 10 days, I heard. Yep. So that's okay. Just don't send it to the CRA. So what do you do now? So really, again, there's two parts of the equation. It's how much you're making and how much you're spending, because it's all about deferral. Mitch said do you leave behind 50? Leaving behind 50 means you make more and spend more, or you make less and spend less. So the first place to start is do a math on your deferral. So figure out, how much do you spend? It's actually, first of all, it's a great exercise to do no matter what. Figure out how much your personal life costs. So, don't include any business expenses. Your car, that goes to the business, any staging, any advertising, meals. Don't include that. Don't include your cell phone, your home internet. What you want to include is how much your mortgage is, property taxes, basically to run your house, how much your groceries are, your gym membership, your personal stuff. Figure out how much you and your spouse need to live off of. That's a good starting point to see if a PREC makes sense. Because then we can figure out as accountants, okay, well, you need $100,000 a year. That means pre-tax you have to take 150. Well, how much do you make? Is there enough meat on the bone there to warrant a PREC? So that's kind of your starting point, is do the math on deferral. Then talk to your brokerage, make sure it's allowed. Just there's certain things that are happening these days. Talk to your accountant and lawyer. Get your team in place so they can actually file these things. Then you reach out to a guy like Mitch in his office. He basically files the articles of incorporation. Mitch, how long to take in general?
It's typically about 5 days to set up articles of incorporation.
Right. So the message is you can get incorporated very quickly. Okay. It's just a matter of making sure it makes sense and getting the right team in place to have it run smoothly.
There was a question in the chat from Kiki about the setup costs. On the accounting side, your setup, there is no real setup cost on the accounting side. It's on the legal side, the $1,500 I was talking about. On the accounting side, annually, you're going to spend, let's say, $3,000 to $5,000 to do your corporate tax return. Kiki put in the chat that she was paying $900 for a return now. That's for a personal return. It is going to cost a lot more to do a corporate return. But
you should see some relief on the personal side. And, it won't offset itself. Like the corporation will be more expensive than $900. But, your personal tax filing, assuming there's no self-employed income. So, for example, if you set it up now, in 2021, your personal tax filing costs should go way down, all things being equal. And your corporate fees will obviously be higher than that, but you're not going to layer the two on top of it necessarily. Okay. Another thing to consider that is kind of moving around all the brokerages, and just talk about it before we go into more questions, is deals written and not closed. Okay. Meaning you've already done the work for a deal. It's in queue to close, let's say the end of November. And let's say you're going to incorporate your PREC tomorrow. The question becomes, can that income be recognized in the PREC? That is not a black and white answer. There's been a bunch of tax people, and I know the brokerages are looking at it too. I will say, just talk to your accountant about that. I mean, it's a gray area, and you just need to be aware of the risk if you're going to take that risk. So just a comment there, because I know we'll probably get the question on how to treat that. And it's not as black and white. For any new deals written, obviously that will go into the PREC, but for deals written and not closed, you need to be careful on that one, and just understand what the decision that you're making is and the potential repercussions should the CRA disagree with you. Just to add to that point, there is a black and white answer. If you want to know if you can roll back some of your commissions to, for the last 3 months and put them into your PREC, the answer is coming to you in about 3 or 4 years, because it will come to you. What will happen is 3 years down the road, some people that rolled back their commissions will get audited, and then CRA will impose penalties and interest on those commissions that they rolled back and put into their PREC. So this is for deals that they did, let's say 2 months ago, 3 months ago. And then those people will not be happy with the penalties and interest that CRA charged. And then they'll go to tax court. And then they'll pay someone $20,000 to fight it out in tax court. And then eventually we'll get a ruling. And tax court will say whether that was legitimate or not legitimate. But that's 3 or 4 years down the road. And if the ruling is that it wasn't legitimate, then chances are you're going to get an audit of the ones that you put in that you shouldn't have put in. And you're going to have to pay 18% from the date of that transaction, the date of that payment, retroactive. They're going to charge 18% interest plus penalties. And it might be dating back 3 years or 4 years at that point. So that's part of the equation that you have to factor into whether or not you want to push your brokerage to putting old deals into your PREC. So in my
mind, is it really worth it? And I don't think it is to take on that risk. But it's an individual's decision whether they do or they don't.
Mitch, there's a question here. Is it mandatory to have a lawyer set up a PREC?
No. PREC could be set up by an online incorporation firm, anybody like that. The only thing is that the PREC has to be set up in accordance with the regulations that just came out. So in other words, there's restrictions on what the PREC can do, and that should be in your articles. So yeah, you can have somebody do it as long as they're familiar with the restrictions and the regulations that have been set by the government of Ontario.
And to add to that, I mean, you never really need to use professionals. I mean, you could also file your own corporate return, for example. I mean, but the reality is if you don't set up, this is a sophisticated structure, and you don't even deposit. Let's say you don't deposit your shares properly, even there's a question of if your corporation is even valid. So there's these are complicated structures, and you should get the right advice, set them up. The other thing is, there might be a goodwill rollover required on setup, which you will need a lawyer to write certain agreements in place on, because you're basically transferring all this income from yourself to a corp, and we don't want the CRA taxing that transfer. So it's not as, we make it seem easy where you just go and incorporate and run your income through a PREC. It is, but you just have to, there is certain advice that you need to figure out if you need these things, for example, like a goodwill rollover, which all the other professions do, and maybe you're transferring other equipment or your car or something into the PREC. So, these are things that have to be considered, and you should, get an advisor like Mitch to make sure they are considered. There was another question here about owning real estate within a PREC. So, Mitch, you're more of a legal structuring question. What, you want to comment on that?
So the short answer is yes. You can own real estate in a PREC. You can own stocks, bonds, mortgages, any kind of passive investment you can own in your PREC. What you can't do is you can't have an active business in your PREC. So you can't have your staging company as part of your PREC, or if you have any other ancillary businesses to your real estate practice, you can't have that part of your PREC. But just a straightforward investment in something, you can absolutely do. Is it wise to do that? Possibly not. So, what I've been telling people is, and in my own experience, I'm getting income in my professional corp. I'm not buying real estate in my professional corp. I have a separate holding company to buy real estate in. So I transfer my money from my professional corp to my holding company. Jordan has told me all along, there is no tax when you transfer money to between companies that you own yourself. And then that separate company, which does have legal liability, is out buying real estate. So in other words, if I get sued in my professional capacity, they can't go after my rental property that I've got in Leslieville.
So, yeah, the reality is again, you want to keep the money in your corp, and then, your advisors will tell you how you can buy your next property, or, if you're doing anything sort of like real estate investing. We can structure it so you don't basically pay tax on putting those investments in. And, oftentimes certain things will happen in the PREC, for example, a stock account, and like rental properties might or might not happen in the PREC depending on your situation.
It brings up another topic on borrowing money in the PREC. Because, if you are buying all cash, then there's no issue. But if you want to borrow money and get a mortgage on that investment property, and you're trying to do it within your PREC, it becomes, a little bit more complicated. So it's not impossible. It can be done. But one of the things I was telling people is, if you're planning on buying an investment property, let the dust settle on the PREC for a little while. So for example, because what you're going to have to do is show your income to the bank. And if you've been getting all your income personally, and now all of a sudden you're splitting it up, or part of the year is in a PREC, it's going to be very hard to describe that to the bank. The bank will eventually understand it, but it makes things more complicated. So, you might want to finish off the year, if you're going to buy something, let's say in the spring, you might want to finish off the year personally, so you have a good, solid tax return for 2020 personally, and then start your PREC in January 1, because you might want to time it that way so that you don't have any issues getting the mortgage that you want to get if you're buying an investment property.
Right, because Mitch, maybe we all forget that question. So you will be able to get a mortgage, it just takes longer, correct?
Absolutely. Yeah, the banks, they give doctors, dentists, lawyers, we all get mortgages. It just takes longer for the banks to go through all the paperwork. And sometimes, like, the banks might want to see financial statements. And if you just started your prec in November of 2020, you're not going to have financial statements until, long after January or February of 2021. So there's a long time delay before you have financial statements. So now you're in a situation where you're showing them your income and your personal returns, your last 3 years of NOAs personally, and then you're going to have to show the bank your commission statements that are going into the prec, and show the bank that, I guess, an interim operating account for that prec to be able to convince the bank to loan you the money. It's more for them to take in and evaluate, and it will take longer. So it's not like, when you're talking to your mortgage professional and they say, oh, we can turn this around in 3 days or 5 days. This is going to take a month to get that commitment, doing it with your prec.
Right. There's a question here. Should I be buying real property intended to be used specifically for office space only in the prec? So, if it's a commercial property, I'd probably buy it in a separate company than to own it in your prec. That's the short answer of it. Could you buy your own office in the prec? Well, it would be involved in that active business, then yes. But my concern would be, let's say you move out of that property because you don't want to use it and then rent it to a third party. You can't just move the property easily. So in that case, I'd probably separate out the property into a sister company versus buying in your prec. But you based on the letter of the law, could you? Yes. Would I recommend it? No. Please clarify. The prec would now file and pay HST and income tax quarterly. Would the agent who is taking a management fee, which would be inclusive HST, also have to file and pay HST and income tax quarterly? Well, the answer to that would be yes. If you take a management fee on your personal tax return from your prec, you'd be subject to all the regular HST and installment requirements. But that is one of the reasons why you would consider your compensation planning. So, you probably not want to have to deal with HST on both the personal side and the corporate side. So you'd probably take a salary then. You accomplish a management fee and a salary are taxed the exact same, but one gets you out of the HST world and installment world. And the banks seem to like it better for financing for whatever reason. The short answer is yes, you would have all the requirements, but I think, your accountant would look to do it differently to ease the administrative burden. At what income for an agent does it make sense to incorporate? Assume average cost, rough estimate. It really depends what you spend to answer that one. So an agent who makes $250, spends $250, there's no point of incorporating, right? Subject to my comment on expenses before, but it's not about income. It's about income and spending. It's a two-sided equation. Okay. So the better way to look at it is what Mitch said before. It's leaving behind, so if you're making more than you spend, if that spread starts to be at least, $50,000, then you look at a prec. So to use a top line metric, it wouldn't make sense. I think it's 50,000 of not being spent between what you earn and what you spend personally. Okay, would be the metric. Mitch, any comments on that one?
Even if it's a person that's part of a team. So let's say you're part of a team and you're only getting, because you're part of a team, you're getting, let's say, 50% commission, and that 50% translates into $100,000 of income. But because you're part of a team, the team pays all the expenses. You've still got $100,000 of income. So that it would make sense for you to be in a prec. Whereas if the team is earning $500,000 and their expenses are $450,000, then it makes no sense for the team to be in a prec if it's only $50,000 that they're working off of in terms of sheltering. So it's not about how much money, what income you have. It's about how much net income you have. So if your expenses, if your income is, even if your income is only $60,000 in a year and your expenses are zero, it makes sense for you to have a prec.
Right. So it's exactly that, two sides of the equation. So do you recommend a separate holding company for each real property? I have a thought on this, Mitch, but you want to go first?
No, my thought on it is I use one holding company for properties because I only want to do one tax return. I'm cheap that way, and I'm happy to pay Jordan $5,000 a year, but that's all I want to pay him. I don't want to pay him, or if it's a simple company, I don't want to pay him $3,000 for 4 different companies. That'll be $9,000 a year. I'd rather just pay one shot for my holding companies, but I do keep them separate. Like I have a holding company for real estate and a holding company that I have my mortgage business in and my law practice. Just because I find it easier for me to keep things separate, and accounting and all the other reasons. And Jordan, what do you think?
Yeah, I mean, I couldn't tell you how many, in my view, is unnecessary corporations I see set up in this world, which I think is based on bad advice. Because, you're looking, what's the purpose of a corporation for, is I guess, legal liability protection. And beyond just the tax structure, it'd be legal liability protection. But, I mean, it's far cheaper to just buy more insurance than it is to pay for the shielding. I mean, I'm talking about for residential property. It's far cheaper to buy more insurance than to pay an accountant to set up a corporation for every single property. It just doesn't make any sense. So I think to answer that one is if you're buying residential properties, you could likely put them all together. I'm not talking about an apartment building, right? I'm talking about condos, smaller properties. Put them all together, buy the right amount of insurance, and you should be fine. Unless you really like paying accountants and lawyers, you should be fine.
Yeah, and part of that question is how are you going to plan on financing them? So if it's going to be one-offs, no problem. But again, if you get into the larger properties, banks or whoever's financing a big apartment building is going to want other forms of security, not just the mortgage itself. And then it gets complicated as you keep buying properties because you've given a pledge of your shares and you've given a general security agreement over all the assets that are in that apartment building. And then you go to buy the second apartment building and you're being asked to give the same thing. So when you're dealing with larger properties, that's when it starts to make sense having separate companies, not when you're buying a duplex, a triplex, a single family residence. Then it doesn't fall through that threshold. Anything over 6 units is usually when you have to look at what's the best way to hold this because of the financing side.
Right. So I guess the answer is it depends, like everything else. There's a question here of how will PRECs be treated in the States? If I die, what happens to retained earnings in my PREC? Great question. So the short answer is without any planning, there's double taxation on death. But that rarely happens because you're going to use an accountant that knows how to deal with death and taxes. And at the end of the day, the end result should be you'll pay basically, you'll settle up like a dividend on the retained earnings, and there will be no double taxation. There's certain planning that's done to avoid double taxation. The most interesting thing, though, is that you can do a lot of great planning, when you get to that stage of your life. If this does become a holding company, like say there's a couple $1 million in it, you're no longer practicing, you've figured out that you have far more money than you're going to need to spend on your personal life, and you want to pass it down to your kids. There's some really interesting planning you can do to minimize your estate taxes that you can't do if you're sole proprietor. That includes like estate freezes with family trusts. It includes life insurance planning. There's a whole number of things that we do with estates. But yeah, you shouldn't have to worry about double tax. But with no planning, you will get tax on death. You will, with the right planning, you will pay. You'll just settle up on death like you do on your RSPs or anything else that you own. Oh, that's not a question. That's a comment on the lawyer.
Yeah, no, I just posted in there that in my office, Sophie is the lawyer that does our corporate stuff, and I put her contact information in there. So I'm happy to answer any questions that you might have on PRECs and the positives, negatives, anything. But when it comes down to actually incorporating the company and setting up the shares and the articles, resolutions, all the rest of it, Sophie is the dedicated lawyer in our office that is doing all of this. So if you know you want to do it, there's her contact, and she's happy to help. I like seeing that comment. Thank you, Deb.
So keep sending in your questions, guys. I mean, I'll make a comment while we're waiting. Is corporate year end? So that's a common question we get. So you can pick any year end you want within 53 weeks of setup. You probably want an off calendar year end. So let's say you set up, and you probably want to keep it out of your busy time, right? So, for example, if you're busy in the spring market, you probably don't want to set up a December year end because you usually do the work a couple months after year end. So, maybe if it's good to do the work in the fall, you'd set up like a September year end. It'd also give you good deferral. If you like to do the work in the summer, maybe you set up a June year end. So it kind of depends on your preference, but there's a lot more flexibility than just using a December 31st personal year end. And then you can time when you do the work with when you're not that busy.
Brings up a good point. The provincial government passed the legislation to enable PRECs last March, in the middle of the pandemic, when none of us had any work to do. But unfortunately, they didn't pass the regulations till now, when we're in a hot market. So one of the things that the advice I've been giving to a lot of realtors is, don't divert your attention in a hot market to creating a PREC, even though you're going to save some taxes. Stick to your game plan in terms of getting your deals done. There'll be time for the PREC in January or February when things have quietened down, if they quieten down. But right now, it's, if I were in your shoes and I was in a really hot market and business was great out there, I would be concentrating on not messing with the streak and keeping the great business going, and save the PREC, because it does take preparation. It does take some time and work. If you're able to do that now, that's great. We're happy to create the PREC for you. But if not, don't worry. You could do it in December or in January when things are quieter and you're able to devote the time and effort to it.
That's a great point, Mitch. And, like, for example, in other professions, we're still incorporating doctors, dentists, lawyers that never incorporated because it didn't make sense at the time. It just makes sense now. So this isn't a take it or leave it, let's do it in October type of thing. Make sure in the long run, it is the right fit for you, versus rushing into something you're not comfortable with. You know what I mean? So that's a great point, Mitch.
There was a question about how to name it. There's a lot of misconceptions about naming a PREC, mainly because when PRECs were introduced in British Columbia a little while back, their PREC system is very different from in Ontario. Your PREC actually becomes like a licensed entity to trade in real estate. It's not like that in Ontario. In Ontario, you can call your PREC anything you want. So, if I were to create a PREC for myself, I would probably call it Mitch Corman PREC Inc. Or I might call it Mitch Corman Personal Real Estate Corporation. That way I keep it separate from my other companies, and I'd understand that is my PREC. But if you want to call it XYZ PREC or XYZ Inc., you can call it anything you want. But if you call it something like Apple PREC, chances are Apple already has a trademark for PRECs because Apple owns everything else in the world. So don't call it Apple PREC, because we have to do a name search on no matter what you call it, and we have to make sure that name wouldn't cause confusion in a marketplace with other people that are doing other types of businesses.
And Mitch, to that regard, keep in mind, again, this PREC will pay all your expenses and engage with various entities. So, there is a matter of professionalism, right? Where if you're telling like a staging company or somebody to invoice you, it looks more professional if there's something presentable to them versus maybe a numbered company. So just keep in mind that, this will be representing you in some way, shape, or form, odds are, versus, just being a name that no one sees. People will see the name. There's a question here. If we own a rental property in our personal name, can we sell it? Can we sell it to a holding company? So to answer that is you could always move stuff from your personal to your holding company or your PREC. The bigger question is, does it make sense? You're not going to save any taxes. That 12.2% rate that I presented before, that's only for your active income, meaning your commission business. You earning money as a real estate. The rental income you make from holding stuff, or the income you'll make from a stock account or lending out money, is not the same as that 12.2%. You're at the highest marginal rates. So you're not going to get any advantage on tax perspective of selling the holding company or transferring it in on a tax deferred basis to your PREC or related holding company. So, really, you got to be, and you also got to be conscious of land transfer tax. So can you move stuff around? Yes. Well, if you have a mortgage on it, that's going to be a problem. And then you could trigger land transfer tax. So does it make sense? Probably not, but maybe your next purchase does. So you're probably not going to move around your existing stuff, but your newer stuff will probably be at the corporate level, if that answers it. I just lose my. I think
Yeah,
I just
the
lost
next
my
question
screen.
was on, would I be able to pay family members, kids under 18, for the work they do for me? Like, I've paid lots of people through my prec, and I usually just do it as casual labor. Anything wrong with that? Like, the chances of getting audited for something like that are much less, I think, than actually paying your kids a salary. I don't think that's a good idea. Jordan, what do you think?
It has to be reasonable, so you can't pay them like $150,000. You have to be conscious. Like, you're probably not going to pay them when they're too young. Under the age of like 14. And the key to this whole thing is just paying cash. Like, you can't just say on paper you're paying, right? You have to give them cash. Now, if they give you the cash back, that's up to them. But that's the key to this whole thing, is you can't just record it through a journal entry. Cash has to go and the amount has to be reasonable. So I'll leave it at that. There's a question here. Maybe Mitch, you could take this one. Will having a prec be of any potential advantage of shielding money for a future marriage and divorce? Or this is making it easier to exclude on a prenup agreement? Or more clearly to exclude on a prenup agreement?
My own experience with divorce lawyers is that they're pretty darn sharp. So they will ask the questions of where is your income going, and you'll have to show it to them. So I don't think you can shield money unless you're exceptionally clever. But anybody that knows what a realtor does, they would, just ask the question: are you getting the money yourself, or are you getting it into a prec? I don't think you'd be able to use a prec to shield at all.
And for whatever works, none of the other professions have been able to use their professional corps to shield in a divorce. Can you talk more about the capital gains exemption that you mentioned earlier? Okay, so if you sell the shares of a small business corporation, which this would be, you can potentially get your capital gains exemption. Right now, it's about $860,000 tax-free. So two things have to happen. One is, beyond just the qualifying of your business, you have to actually get someone to buy your business and buy the shares of that business. So that will not be most people on this Zoom. But for certain people that have goodwill, basically non-personal goodwill, like a team, that could be the case. So if you have someone that's coming up in your team, that's going to take over your team, you sell them the shares, and as long as the total consideration is under $860,000 or so, you'll pay no tax on that sale. So that's how it works. You sell shares of your corporation to get it. Okay.
Any other questions? Okay, looks like that's about it. That was easy. Jordan, thank you so much. I don't see any questions. I think they got it.
I hope so. I mean,
maybe
the comment would be is
hands. Who thinks the prec is for them? I didn't see the hands go up. Oh, there we are. We don't have that many people we can see, but we do. I do see some hands up there, which is great.
If you have any questions, just reach out to either of us. I'm sure we'll be happy to answer them for you, and hopefully demystify some of these concepts for you.
Okay, nothing else. Well, I think we're going to sign off then. Thank you guys so much for having us. And questions, reach out to me or Jordan, or I know a lot of you are talking to Katie on a regular basis, or Adam in my office. We're all very well versed in precs. If you want one done, Sophie is the person to send an email to or call, or if you forget who it is, just contact me and I'll put you in contact with Sophie. And Jordan's contact, I think we've already got from the invitation. And that's it. So thank you very, very much for having us.
Thank you very much,
so much for doing this. We really appreciate it.
Our pleasure.
Thanks so much. It was great.
Thank you.
Our pleasure.